Welcome to Iron Financial. This is the only place where we cut directly through the market weakness to help you forge a stronger, more durable portfolio. Welcome to Iron Financial. This is the only place where we cut directly through the market weakness to help you forge a stronger, more durable portfolio. Okay, so let's start with the story everyone else saw. The one that made most of Wall Street just kind of shrug its shoulders and move on to the next shiny object. Mission Produce reported its first quarter numbers, and they missed. Simple as that. They missed on revenue, they missed on earnings per share, and what did the stock do? Pretty much nothing. It dipped a little, it recovered a little, it was a complete and utter non-event. So if you're just a casual observer, this thing looks like dead money, right? Just another boring agricultural stock that's basically going nowhere fast. But I have to ask, is that really all there is to the story here? Because it feels too simple. That's exactly the point. The market is lazy. It is designed to be lazy. It just scans the headlines, looks for a green beat or a red miss, and then the algorithms take over. But the real work, the heavy lifting, the stuff that actually matters, it's all happening below the surface. See, here, we don't care about the fresh coat of paint. We care about the foundation. We care if the rebar is solid. And right now, believe me, Mission Produce is pouring a whole lot of concrete and welding a whole lot of steel while everyone else is distracted by those headline numbers. So here at Iron Financial, we're going to do what we do best. We're going to ignore all that noise, drill down deep into the filings, and inspect the real structural integrity of this company. All right, I get it. But before we start talking about the deep foundation, we have to acknowledge the cracks. And believe me, there are some very visible cracks right on the facade. We have to be clear about the bear case because, frankly, it's simple. It's really easy to understand, and it's the very thing that has most of the market either spooked or, even worse, just completely uninterested. These are the numbers that give all the skeptics out there the ammunition they need to just write this company off. Okay, just look at this slide for a second. Let's be perfectly clear. This is not a small miss. This isn't some rounding error that you could just explain away. The analysts on the street were forecasting nearly $320 million in revenue for the quarter. Mission came in way under that at $278.6 million. Do the math. That's a $40 million hole. That's a miss of over 12%. It's huge. And then you look at the bottom line, earnings per share. They came in 2 cents light at just a dime. In a market like this, a miss is a miss, and a miss this big gives every reason for sellers to just come out and dump the stock. So my question is, how can a company that's supposed to be a leader in its field fall this short of what everyone was expecting? It points to some kind of serious external pressure. And here it is. Here is the culprit. A punishing, absolutely brutal 30% year-over-year decline in avocado pricing. The reason for this is Economics 101, simple supply and demand. A larger, much healthier crop came out of Mexico, and it just flooded the market with supply. Look, when you're in a commodity business, and let's not kid ourselves, avocados are a commodity, price is king. Price is everything. And right now, the price is getting absolutely hammered. So this 30% drop, that's the sledgehammer that just smashed the revenue line to pieces and created that big ugly crack in the facade. For the bears, for the skeptics, the story ends right here. Weak pricing equals weak revenue. Game over. But that's precisely where they're wrong. That's where the market's inherent laziness creates an opportunity for people willing to do the work. Revenue is a facade. It's nothing more than the chrome bumper on a heavy-duty truck. Yeah, it looks nice and shiny, but it tells you absolutely nothing about the engine, the transmission, or the chassis. If you're only looking at the price of the commodity, you are fundamentally missing the entire point of this business. We need to look past that flashy, misleading revenue line and start inspecting the operational foundation. This is where we find the real steel that supports the entire structure. Now, you're right to point out those cracks, but look at what they're obscuring. This slide shows the powerful contradiction that's sitting right at the heart of this company. Over on the left, yeah, you've got the weaknesses you just talked about. Revenue is down 17%. They reported a small net loss. That's what the bears see, and that's all they see. But now look at the right side of the ledger. This is the steel. This is what matters. Avocado, we're talking the actual number of avocados they packed and sold, is up a massive 14%. They are moving more product than they ever have before. They are taking market share. And here is the most crucial metric on this entire page, adjusted EBITDA. That's the best measure we have of their core operational profitability, and it's up 5% to $18.5 million. Now, stop and think about that for a second. The price of their main product absolutely collapses by 30%, yet they somehow manage to grow their core profit. That is not weakness. That is operational excellence. That is leverage. They are turning a pricing crisis into a masterclass in efficiency. And hey, don't just take my word for it. This quote right here brilliantly illustrates their entire strategy. The new incoming CEO, John Pawlowski, he laid it out in plain English on the earnings call. He said, "We are a volume-centric business. Volume and per-unit margins are the metrics we manage to." He is telling the market directly to stop looking at the top-line revenue number. We don't manage for revenue, he's saying. We manage for volume and the margin we make on each and every unit we sell. So the market is punishing them for a metric they aren't even focused on internally. And based on the numbers we just saw, they're executing their stated strategy flawlessly. They're sacrificing what I call empty revenue for truly profitable market share, and that is the sign of a disciplined, focused, well-managed operation. Okay, fine. I will concede that point. That's a strong point. The avocado business is definitely showing some serious muscle, flexing its operational strength even when the environment is this tough. I mean, growing your core profits when your main product's price falls off a 30% cliff? Yeah, that's impressive stuff. But a fortress isn't just one strong wall, is it? The entire structure has to be sound. And when we start looking at the other parts of Mission's business, we find a pretty significant weak point, a financial drag that's holding the rest of the operation back. This was all supposed to be about diversification, but it's really starting to look more like a costly distraction. And I am talking, of course, about the blueberry business. Just look at this chart. This is the weight that is burdening the entire company. In the first quarter of last year, the blueberry segment kicked in about $6.2 million to adjusted EBITDA. That's a respectable number, nothing wrong with that. This year, that number has been nearly cut in half. It's down to just $3.3 million. That is a nearly $3 million hit straight to the bottom line, coming from just one segment. So while the avocado team is sweating and straining and pushing profits higher against this pricing tidal wave, the blueberry segment is just leaking profitability all over the place. It's like a boat anchor tied to a speedboat. And this isn't a small problem. This is a significant drag on the company's overall performance. You're absolutely right. It's a drag. Nobody is debating that. The numbers are what they are. They're perfectly clear. But the difference between a real structural failure and what is essentially a planned renovation is whether or not management has a blueprint. And they do. This isn't a surprise to them. It's a known issue, and they're already working on it. On the call, the CFO, Brian Gills, he directly addressed the problem. He explained that the lower yields are happening because they have newer acreage that is still maturing. This is a farming issue, it's a biological cycle, not a fundamental business model failure. And crucially, he put a timeline on it. He's telling investors, look, give us 12 to 18 months and this issue will be resolved as these farms reach their full productivity. This isn't a panic, it's a projection. They've identified the problem, they've explained the cause, and they've given a clear timeline for the fix. To me, that's not weakness, that's just transparent management. Exactly. And this is the point in the story where everything pivots from defense to pure offense. Everything we've talked about so far, managing pricing, executing on volume, fixing the blueberry segment, that's all about reinforcing their existing structure. That's about making sure they can weather the storm. But now we have to talk about the massive expansion plan, because they aren't just renovating the building anymore. They are acquiring the skyscraper next door and bolting it onto their own. I am, of course, talking about the game-changing, industry-altering acquisition of their main rival, Calavo Growers. Make no mistake, this is not some small bolt-on acquisition that they do on a Tuesday. This is a truly transformative merger. What they're doing is combining two of the biggest and most respected names in the entire avocado space to create an undisputed titan. This is a scale play, in a game where scale is absolutely everything. We're talking about sourcing power, global distribution networks, and deeply entrenched customer relationships. This move is designed for one single purpose: market domination. It enhances their scale, it diversifies their sourcing away from just one region, and it fundamentally changes their position in the global produce landscape. This is the kind of strategic move that takes them from just being a strong player to being the one who gets to set the rules of the game. Okay, hold on. I feel like I've heard this 1,000 times before. Every single company that makes a big acquisition puts out a press release that's full of these corporate buzzwords. Expand platform, diversify, enhance reliability. It's all just talk. It's the standard playbook they use to sell a deal to the street. And then, of course, you get to the magic word, synergies. It's got to be the most abused term in all of finance. It's his promise of free money that almost never actually materializes. It's supposed to be 1 + 1 = 3, but way too often it turns into 1 + 1 = a giant pile of debt and integration headaches. So is this real, or is it just corporate fluff designed to sell a deal to shareholders? I want to see the hard numbers. Where is the actual steel behind all of these buzzwords? Right here. This is the number. This is the steel. Management isn't just vaguely throwing around the word synergies and hoping for the best. They have put a number on the table that they know they will be judged against. They're targeting at least $25 million in annualized cost synergies. And that's not a suggestion. That's a commitment. Now, listen to the language they're using on the calls and in the press releases. They have consistently and repeatedly signaled that there is meaningful upside to that $25 million figure. They are telegraphing their confidence to anyone who is paying attention. This isn't some vague hope. It's a specific, quantifiable target that's built around consolidating their operating footprint, G&A, and logistics. This is the financial bedrock of the entire deal. That $25 million synergy number sounds great, I'll give you that, but it's in the future. The company has to survive the present first. Let's be realistic here. Those synergies aren't going to be realized for up to 18 months after the deal even closes. But the pressure isn't in 18 months. The pressure is here now. That pricing storm isn't letting up. So before they can even begin all that heavy lifting of integration, their existing foundation is about to undergo a very severe and very immediate load test. So the question becomes, can this company actually withstand the immense pressure that's bearing down on it in the very next quarter? And this chart shows exactly what I am talking about. This isn't a one-quarter storm that has already passed us by. No, it's actually getting stronger. Management's own outlook for the second quarter is calling for industry volumes to swell by another 10 to 15%. That's even more supply flooding the market. And then look at the pricing. They're forecasting another punishing, just brutal decline of 30 to 35% year over year. That is a brutal, brutal environment to operate in. It puts immense direct pressure on their per unit margins, which is the very metric they say they manage the business to. In fact, they have explicitly guided that their core profitability, their EBITDA, is going to be lower next quarter. That's a huge step backward before they can even think about taking 2 steps forward. You are absolutely right. They are forecasting a decline. They are walking into the storm with their eyes wide open, and they're telling their investors to brace for impact. But that is not a sign of a company that's in trouble. That's the sign of a management team that truly understands its business cycle. But context here is everything. This timeline puts that short-term pain in its proper place. Look at it. Step 1, absorb the pressure. Q2 will be tough. They know it. They will take the hit on margins and EBITDA. Step 2, close the deal. They're targeting the third quarter to get the Calavo merger finalized. And then step 3, execute the plan. That is when the 18-month clock officially starts on unlocking those $25+ million in synergies. This isn't a story of a slow decline. This is a story of a tactical retreat and a consolidation before a massive strategic advance. They're weathering the storm to position themselves for total dominance when the skies eventually clear. Okay, so there it is. We've seen the entire blueprint now. We have inspected the cracks in the facade, we have tested the steel in the foundation, we've accounted for the dead weight from that blueberry burden, and we've analyzed the architectural plans for this massive new expansion. We've laid out the bull case, and we've laid out the bear case. So now, it is time for the iron verdict. So when it all comes down to it, is Mission Produce building a fortress, or are they building a trap? The bull case, the fortress, is built on a very solid foundation of dominant and, more importantly, growing avocado volume. They've proven to us they can expand their core margins even in a terrible pricing environment by focusing on that operational excellence. And the Calavo acquisition provides a clear, quantifiable path to massive, game-changing synergies. The problems they face, like the blueberry segment, they appear temporary and they appear fixable with a clear timeline. But on the other hand, the trap is just as clear and just as dangerous. The pricing headwinds are not some theoretical risk. They are severe and they are happening right now. They're actually getting worse next quarter. The blueberry business is an undeniable drag on profitability today, not 18 months from now. And we can't just gloss over the risk here. Taking on a bunch of debt and trying to integrate a massive rival right in the middle of a cyclical downturn is incredibly difficult. It's a textbook way to destroy shareholder value if it's mismanaged. And remember, they are literally telling us to expect their core profitability to decline in the immediate future. That sounds a whole lot like a trap if I've ever seen one. The iron verdict is this. This entire investment thesis comes down to one single word: execution. The pieces are on the table for management to forge an absolute titan of the produce industry. There's no doubt about that. They have the volume, they have the operational leverage, and they have a strategic acquisition that could create a deep and wide competitive moat around their business. But if the timing is off, if the integration stumbles, if that pricing environment stays in the basement longer than they expect, this fortress becomes a financial trap, collapsing under the weight of its own debt and its own ambition. So the ultimate question for any investor looking at this stock is the one right here on your screen. Can this management team execute a complex, company-defining merger while simultaneously navigating a brutal cyclical downturn in pricing? The answer to that question will determine everything.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.